Top picks here on Market Call. We're back with Brian Madden. He's with First Avenue Investment at Counsel. Number one today, Brian, Waste Management Company, the big waste hauler and recycler in the United States, WM on the New York Stock Exchange.
That's right, Paul. And I got a riff off of Andrew Bell's comment in the earlier segment that cash is not trash. This is a company that turns trash into cash. And for those who don't know it, it is the biggest and the best in class company in the United States solid waste industry, operating collection, recycling, transfer, and landfill operations in 49 U.S. states and in Canada. It is an industrial. It's a light industrial, though, because, again, thematically back to what we've been talking about through the show, waste collection is a need and not a want. So whether you're in an expansion or in a recession, the garbage has got to go somewhere, and they pick it up. They operate mostly in urban areas where pricing power is maybe not as strong as in the less contested rural or suburban markets, but unit volume dynamics are better given demographics. Competitive advantages here include integrated ownership of 260 landfills. That's important because of not in my backyardism. Nobody wants a dump in their backyard, so they have capacity, whereas others maybe don't. Financial strength is an advantage here. They have an A-rated balance sheet. That matters because rates are going up. Credit spreads are widening, so they're almost bulletproof in terms of financial strength. 2% yield, the dividend grows about 6% a year, earnings grow about 8%, so it all rolls up nicely to a high single-digit growth algorithm with good visibility through up and down economic cycles. So new addition to our dividend growers portfolio. And we took this opportunity to high grade the portfolio, trading a lesser quality waste collection company for a better one. That's what you do in down markets. You put trophies into your portfolio at discounted prices. And that's how we see this one.
And Brian and his colleagues did make a purchase on this one this month in June of 2022. Dollar General is the next one. All kinds of focus on the retail sector. It's been tumultuous out there for a good month or so. We've had big warnings from the likes of Target and Walmart. You like Dollar Tree as top pick number two.
Sorry, small correction there, Paul. It's actually Dollar General.
Dollar General. I apologize. Dollar General. You're quite correct. And we're showing Dollar General on the screen right now. Ticker symbol DG on the New York Stock Exchange.
Good. So yeah, also a new addition to the portfolio. Again, we got this opportunity when the market threw a temper tantrum in the U.S. and basically threw this baby out with the bathwater of all the other retailers. We saw Amazon take a face plant. We saw various other retailers falling 20, 25, 30% in a day. And this stock corrected almost 30% off its peak. But this is not your garden variety retailer. This is a retailer that's actually advantaged in an environment where consumers are tightening their belts. Because they run dollar stores. And unlike in Canada, the merchandise assortment there is about 75% consumables. So think of something that's a hybrid between a really hard format discount grocer and a general merchant. And so what you have is traffic flows to them away from other retail formats as consumers feel the pinch and look for the cheapest place to buy that can of beans or tuna or whatever. I can tell you, Paul, it's not going to be Whole Foods. It's more apt to be Dollar General. There's also a good organic growth algorithm apart from same-store sales. They're opening about 1,000 new stores a year, and it all rolls up into a 12 to 14% annual earnings growth rate on average over a cycle. So great entry point, very timely name.
Okay, less than 90 seconds left, so we're going to ask you to be brief again. TransAlta is pick number 3, ticker symbol TA on the TSX.
So TransAlta is a merchant power generator, primarily in Alberta, some operations in the U.S. and in Australia. It's pivoting away from legacy coal generation towards more renewables. We think that's got re-rating potential over time. And this stock trades at about a 50% valuation discount to the pure play renewables merchant power generators. Lastly, although it's a utility, it's got defensive attributes in that sense. but it's in Alberta. So it's sort of a backdoor play on strength in the oil patch, which we foresee continuing. So we're here for the income of 2+%. We think that'll grow. And we think capital appreciation is on the table here as well. So fairly new name in our momentum portfolio. Looks good to us at these levels and breaking out in the charts too.
Brian.